What if I told you most people aren't actually investing in the stock market? They're unknowingly donating to it. The market doubles, headlines cheer new highs, yet your account barely moves. The rich aren't lucky, they're playing a completely different game. And the wild part? It's been hiding in plain sight the whole time. Have you ever watched the S&P climb and think, where is my growth? How is everyone else winning except me? It feels unfair. You're saving, buying stocks, checking your portfolio, doing everything right, yet the progress is microscopic. Meanwhile, the top 10% watch their wealth grow like it's on cruise control. My name is Alex, and after years of studying how people actually build wealth, I realized something uncomfortable. Regular investors and wealthy investors aren't even participating in the same version of the market. One group is guessing, the other follows a strategy so steady and systematic that it almost feels rigged. If you like clear, rational breakdowns that make money feel simpler and more manageable, consider subscribing so you never miss a new deep dive. So here's the real question. What are the rich doing in the stock market that everyone else completely overlooks? Today, we're breaking down how wealthy investors truly build and protect their money, step by step. The first rich upgrade, strategic stock picking. When most people hear rich people pick stocks, they picture someone glued to 6 monitors, timing the market like a Wall Street movie scene. But that's not what actually happens. The first real upgrade wealthy investors make isn't about trading faster or gambling harder. It's about introducing strategy into an area where most people rely on luck. Regular investors tend to buy whatever is popular in the moment, a trending company, a flashy headline, a viral post on Reddit. It feels exciting, it feels smart, and for a while it even feels profitable. But wealthy investors operate differently. They treat a stock not as a lottery ticket, but as a small ownership stake in a real business. And businesses don't transform overnight, they move with fundamentals. This means wealthy investors choose individual stocks for a reason that goes beyond hype. Some follow a value investing mindset, looking for companies trading below what they're actually worth, based on earnings, cash flow, and long-term growth. Others focus on growth companies that are expanding fast and have a clear competitive edge. And some simply want stocks that pay reliable dividends so the income compounds year after year. But the key is this: they research. They study revenue trends, check profit margins, compare valuation ratios, and look at how a company performed during past market cycles. It's slow, steady, and ironically, boring. Yet boring is exactly what works. And here's something most people never think about. Wealthy investors expect to be wrong sometimes. They don't assume every stock will be a winner. They build a structure around their decisions, position sizing, diversification, and clear expectations. This protects them from their own mistakes, which is something retail investors almost never prepare for. The biggest difference is psychological. Wealthy investors don't chase quick wins. They focus on long-term compounding. They're comfortable holding a stock for years, even decades, because the decision wasn't based on emotion. It was based on data, patience, and a clear strategy. So while others chase the next big hit, wealthy investors quietly build a portfolio of businesses they understand, measured, intentional, and protected by discipline. Protecting the downside, hedging like the wealthy. Here's a truth most people never learn until it's too late. Wealthy investors spend just as much time trying not to lose money as they do trying to make it. In fact, protecting the downside is often the real reason their portfolios grow steadily while everyone else rides emotional roller coasters. This is where hedging comes in. A strategy that sounds complicated but exists for a simple purpose: reduce the damage when the market turns against you. Most regular investors imagine investing as a straight line. You buy a stock, the price goes up, and you make money. But wealthy investors know the real world is messier. Prices swing. Sentiment changes. Recessions happen without warning. So instead of hoping the storm never comes, they build umbrellas in advance. One of the clearest examples is what Mark Cuban did in the late 1990s after selling his company to Yahoo. He suddenly owned a massive amount of Yahoo stock, and he knew the dot-com boom was looking shaky. Instead of gambling on optimism, he used something called an options collar. It sounds technical, but here's the idea in plain English. He bought a put option to guarantee he could sell his shares at a certain price, even if the stock crashed. Then he sold a call option, giving someone else the right to buy his stock at a higher price, which helped pay for the protection. He traded unlimited upside for peace of mind. When the bubble eventually burst and Yahoo's price collapsed, he walked away without losing a cent. Not luck, preparation. That's the mindset wealthy investors use. Hedging isn't about predicting the future. It's about respecting the fact that the future is unpredictable. Sometimes they use puts to protect a big position. Sometimes they use calls to generate extra income. Sometimes they hedge the entire portfolio during uncertain periods. Regular investors see hedging as unnecessary complexity. Wealthy investors see it as seatbelts. Not because they expect to crash, but because they want to walk away if they do. By limiting the downside, they preserve the compounding engine that keeps them ahead, quietly, consistently, and with far less stress. Leveraging capital. The risk tools millionaires use. If hedging is the seatbelt wealthy investors use to protect themselves, leverage is the engine they occasionally turn on when they want to accelerate. And this is where most people misunderstand what the rich are actually doing. They're not taking reckless bets. They're using borrowed money in a controlled, intentional way that amplifies their strategy, not their emotions. Most regular investors hear margin or leverage and immediately think of danger. And to be fair, it can be dangerous. Borrowing money to invest means your gains and your losses grow faster than normal. Put simply, if you invest $1,000 of your own money and borrow another $1,000 from your broker, you're now controlling $2,000 worth of stocks. If those stocks rise, your returns are nearly doubled. But if they fall, your losses hit twice as hard. Millionaires understand this math better than anyone, which is exactly why they treat leverage like a tool, not a shortcut. They never use it to get rich quick. They use it when the odds are clearly in their favor, when the downside is protected, and when the broader portfolio can absorb a mistake. In other words, they don't use leverage to make risky decisions. They use leverage to scale smart ones. Take real estate investors as an example. Borrowing money to buy a property is considered normal, even responsible, because the asset produces income and holds long-term value. Wealthy stock investors apply similar thinking. They use leverage when they're buying quality businesses, not speculative flyers. And they're always aware of something most retail investors ignore. Leverage magnifies discipline just as much as it magnifies mistakes. Another advantage, wealthy investors often have access to lower interest rates and more flexible lending terms. When you can borrow money cheaply, leverage becomes less dangerous and more strategic. But perhaps the biggest difference is psychological. Regular investors use leverage when they're feeling excited. Wealthy investors use it when they're feeling certain. They treat borrowed money with the same seriousness as their own because the cost of being wrong is too high. Used well, leverage is a way to grow wealth faster. Used poorly, it's a shortcut to wiping out years of progress. And the rich know exactly which side of that line they want to stay on. Outsourcing brains. Hedge funds for high net worth investors. There's a point in wealth building where time becomes far more valuable than trying to outsmart the market. Millionaires reach that point early. They're running businesses, managing teams, overseeing investments, so watching stock charts all day simply isn't realistic. And at the same time, pure passive investing doesn't satisfy their goals anymore. That's where hedge funds enter the picture. A hedge fund is basically the private club of investing, not because it's glamorous, but because it's built for people with capital, complexity, and very specific goals. Think of it as hiring a team of highly trained professionals, not to beat the market every day, but to operate with strategies most individuals could never execute alone. These funds don't follow one simple playbook. Some hedge funds bet on stocks rising while shorting others falling. Some study global interest rates, political events, or supply chain shifts around the world. Others analyze bankruptcies, mergers, regulatory changes, things ordinary investors rarely have the time or tools to understand. Take Bridgewater Associates, founded by Ray Dalio. It's the world's largest hedge fund, and it doesn't think in terms of individual stocks. It thinks in systems. How inflation in Europe interacts with currency fluctuations in Asia. How oil supply affects corporate profits. How interest rate shifts ripple across global markets. It's a different scale of thinking, one most individuals simply can't match. That's the real benefit wealthy investors get from hedge funds. It's not just access, it's expertise. Thousands of hours of research condensed into a strategy designed to make money whether the market is going up, down, or sideways. But what makes hedge funds so appealing is not the promise of hitting home runs. It's the promise of consistency. Millionaires aren't looking for the next explosive stock. They're looking for stability wrapped in sophistication. They want a portfolio that keeps growing even when the headlines look ugly. For regular investors, hedge funds feel distant and unattainable. For wealthy investors, they're a natural evolution, moving from doing everything themselves to delegating the most complex, high-stakes decisions to people who live and breathe financial systems. It's not about ego. It's about efficiency. The algorithmic elite, quant funds. If hedge funds are the private clubs of the investing world, quantitative funds, better known as quant funds, are the secret laboratories. This is where math, data, and computer science take over, and where even wealthy investors suddenly feel small. And because at this level, intuition isn't part of the equation, human judgment barely plays a role. Everything is driven by patterns, probabilities, and algorithms that see what the rest of us never could. Most people invest based on stories, a new product, a promising CEO, a headline that sparks excitement. But quant funds don't care about stories, they care about signals, tiny, consistent behaviors hidden inside millions of data points, price movements, volatility shifts, order flows, correlations between industries, even satellite imagery showing weather patterns or factory activity. If it can be measured, a quant fund will analyze it. The most famous example is Renaissance Technologies, founded by mathematician Jim Simons. Their flagship Medallion Fund is so successful that its returns sound like fiction. This fund doesn't read earnings reports or watch CNBC. It runs massive models that execute thousands of trades per day with frightening precision. When a certain stock rises quickly in the morning, their system might predict a small afternoon dip and automatically short it for a few hours. When rainfall decreases over the Midwest, their models might anticipate fertilizer demand rising the next week. These aren't guesses, they're statistical outcomes backed by decades of data. And the results? Medallion has produced annual returns so high and so consistent that even most millionaires can't get in. The fund is closed to outside investors and is run exclusively for employees and insiders. It's not elitism, it's capacity. These models only work at certain sizes, and too much capital would break the system. For wealthy investors, quant funds represent the upper edge of what's possible when capital meets computational power. It's not about being smarter than the market, it's about finding tiny inefficiencies that happen over and over again, and exploiting them before anyone else notices. This is the part of the investing world regular investors never see. And ironically, it's where some of the most reliable, repeatable wealth creation happens, quietly, mathematically, and at a speed no human could ever match. The billionaire level building a family office. There's a moment where even hedge funds stop being enough. Not because they don't work, they do, but because they aren't built around one person's life, one person's goals, or one family's long-term plan. Millionaires invest in markets, billionaires build systems around themselves. And the ultimate version of that system is something called a family office. A family office is basically a private wealth command center. Imagine having your own team of analysts, tax attorneys, accountants, real estate specialists, portfolio managers, and legal strategists, all working exclusively for you. It's like merging a hedge fund, an accounting firm, an estate planning team, and a strategic advisory board into one unified structure whose only job is to grow and protect your wealth. Most people think billionaires are out there hunting for the next hot stock. They're not. Their family office handles that. What billionaires actually focus on is structure, reducing taxes, minimizing risk, planning for future generations, and making sure every dollar they earn stays inside a system that compounds quietly for decades. Here's the important part. A family office isn't about chasing high returns. It's about synchronization. Stocks, real estate, private equity, tax strategy, legal protection, everything moves together under one coordinated plan. While regular investors worry about picking the right ETF, a family office is optimizing for everything from how assets are held, to how loans are structured, to how wealth transfers occur without triggering unnecessary taxes. This is also where they access deals the public never sees. Pre-IPO shares, private company buyouts, real estate syndications, strategic partnerships, opportunities that require deep networks and large capital commitments. A hedge fund might invest for wealthy clients, but a family office invests around its owner, tailoring every move to long-term legacy rather than short-term wins. But the biggest advantage isn't the expertise, it's the alignment. Everyone in a family office works for a single goal: protecting and multiplying one family's wealth across multiple generations. It's the point where money stops being managed and starts being engineered. Private equity and venture access. Once you reach the family office level, the investing world starts to look very different. Public stocks are no longer the main course, they're more like a side dish. The real opportunities, the ones that quietly create billion-dollar fortunes, live in the private markets. And this is where private equity and venture investing come into play. Most regular investors only see companies after they go public, after the growth curve has already steepened, after the insiders have taken the biggest share of the upside. But wealthy investors often get in years earlier, when a business is still young, unpolished, and, most importantly, undervalued by the rest of the world. Private equity is basically buying ownership in companies before the crowd arrives. Sometimes it's taking over an entire business, improving it, and selling it later for a profit. Sometimes it's investing in a startup that has big potential but needs capital to grow. And sometimes it's getting access to a company that will eventually go public, allowing you to benefit from the entire run-up, not just the tail end of it. Jeff Bezos invested in Google in 1998, long before it became a household name. Peter Thiel put $500,000 into Facebook and walked away with over $1 billion. Elon Musk backed Stripe early, years before the public even knew what it was. These aren't lottery wins, they're examples of what happens when you see a company before the rest of the world catches on. But these deals aren't listed on Robinhood, and they don't show up on stock screeners. They happen through networks, relationships, and capital commitments that most investors simply don't have access to. That's why the family office model matters so much. It opens doors that stay closed to almost everyone else. Private equity also offers something public markets rarely do: control. Wealthy investors can influence decisions, shape strategy, and guide the company toward outcomes that protect and grow their investment. They're not passengers anymore. They're part of the steering wheel. For the ultra-wealthy, private markets aren't a side hobby. They're the arena where outsized returns are born, quietly, early, and far away from the noise of the public market. Tax loss, harvesting. One of the biggest advantages wealthy investors have isn't a secret investment or a special type of stock, it's the way they handle taxes. And tax loss harvesting is one of the simplest, smartest tools in that playbook. It sounds technical, but the idea is surprisingly straightforward. Use your losing investments to reduce the taxes you owe on your winning ones. Most regular investors hold on to a losing stock because they're hoping it will bounce back. Wealthy investors do something different. If a stock drops below what they paid for it, they'll often sell it, not because they're giving up, but because that loss becomes valuable. That loss can offset gains they made somewhere else in the portfolio, lowering their capital gains tax bill. And here's the clever part: they can often buy a similar investment right after selling the loser, keeping their overall strategy intact while still capturing the tax benefit. It's like turning a setback into a shield. Family offices do this constantly, sometimes harvesting losses across dozens of positions each year. It keeps more money compounding and less money disappearing into taxes. It's not glamorous, but it's one of those quiet techniques that separates long-term wealth builders from everyone else. Buy, borrow, die. If there's one strategy that truly separates billionaires from everyone else, it's this one. Buy, borrow, die sounds dramatic, but it's really just a tax-efficient way of using wealth without ever triggering a massive tax bill. Here's the logic: when someone buys a stock and it grows in value, the gain isn't taxed until they sell it. Wealthy investors take advantage of that by simply not selling. Ever. Instead, they use their appreciated stock as collateral to borrow money from the bank. The loan gives them cash to live on. Millions, sometimes hundreds of millions. And because loans aren't considered income, they aren't taxed. They pay a small amount of interest, but compared to the taxes they avoid, it's a bargain. Then comes the final phase. When they pass away, their heirs receive the stock with something called a step-up in basis, meaning all those decades of gains are wiped clean for tax purposes. No capital gains tax, no giant bill. just a fresh start. It's legal. It's common among the ultra wealthy. And it's one of the most effective ways to keep wealth growing across generations. Buy, borrow, die isn't about loopholes. It's about understanding the rules better than anyone else. Donating appreciated stock. When wealthy investors finally decide to part ways with a stock, they rarely sell it. Selling triggers capital gains tax, which can take a huge bite out of decades of growth. Instead, they use a smarter move, donating the appreciated stock directly to a charity or their own foundation. Here's why it works so well. Let's say a stock was bought for $10,000 and is now worth $50,000. If they sold it, they'd owe taxes on that $40,000 gain. But by donating the stock itself, they avoid that tax completely. The charity receives the full $50,000 in value, and the investor gets a tax deduction for the entire amount. It's a double win. No capital gains tax and a large deduction that reduces their taxable income for the year. This is why people like Warren Buffett, Bill Gates, and Mark Zuckerberg donate stock instead of cash. They're not just being generous, they're being strategic. The move allows them to support causes they believe in while keeping their long-term wealth plan efficient and tax smart. For the ultra-wealthy, giving isn't just an act of kindness. It's a financial strategy that preserves wealth, reduces taxes, and reinforces the compounding engine behind their net worth. Key takeaways. When you lay everything out side by side, the biggest difference between regular investors and wealthy investors isn't the specific stocks they pick. It's the system behind their decisions. Regular investors focus on what to buy. Wealthy investors focus on how the entire machine works together. They build guardrails, they plan for mistakes, and they prioritize protecting their compounding engine above everything else. That's why the rich treat investing like infrastructure, not entertainment. Blue chip stocks, index funds, smart diversification, that's the foundation. Strategic stock picking adds precision. Hedging reduces the damage when markets fall. Leverage, used carefully, accelerates good decisions. Hedge funds and quant funds add expertise that's impossible to replicate alone. And at the top, family offices engineer wealth at a level where taxes, structure, and legacy matter just as much as returns. The takeaway is simple: investing isn't how people get rich. It's how people stay rich. The stock market rewards discipline, structure, and patience, not speed or excitement. If you start thinking like the wealthy, protecting the downside, planning for the long term, and letting compounding do the heavy lifting, you're already playing a completely different game than most investors. And that shift alone can change your entire financial trajectory.